or good afternoon, depending what part of the country you're in. Thank you for joining us for today's training on mastering short-term rental property loans. As you all know, this is a very hot segment of the industry, and we want to make sure that you are properly positioned to take advantage of all the great products that we have to offer that can assist with this type of transaction. So let's get right into it. Mastering short-term rental property loans. Now, it's very important to note what exactly is a short-term rental property, right? Short-term rental property is a property that can be legally rented by the day, week, or month. Now, it is very important to note that do not confuse short-term rental properties with condo hotels. Now, condo hotels are usually going to be short-term rental properties, but they tend to be much more restrictive, right? Condo hotels usually have deed restrictions. Not all of them. I'm not going to say 100% of them do, but most of them have deed restrictions, which are going to prevent how often the owner can occupy the property. In some cases, it'll state that they can't occupy it for more than 6 months in a calendar year. Other times, it may state can't occupy for more than 30 days continuous. Whatever the deed restrictions may be, they are going to vary. And sometimes the restriction is actually from the city if the property is deemed a condo hotel, like in Sunny Isles, Florida, for example. So do be aware that not all short-term rental properties are condo hotels. If you do have one that is a condo hotel, then you need to review those guidelines specifically to see what you can do in light of what we're going to discuss now in our presentation. Uh, Now, a short-term rental property is usually not going to have any type of a lease, except for maybe a property management lease. Be aware this may present some issues in the structure of your loan after you review the guidelines, because unleased properties may have LTV restrictions. And in some cases, for example, if it's a refinance, may not be possible to do at all. So I can't really generalize all guidelines as one, but I am pointing out what the obstacles may be if it is a short-term rental property. Are not going to have a lease. Now, again, this is when it is a purchase. Excuse me, backwards. This is usually an issue when it is a refinance and not a purchase, because when it is a purchase, the property can be vacant, right? It's not yet owned by the borrower. And I'm going to touch base on that in a minute regarding structuring your short-term rental property loans, but let me cover this other um, two important bullet points here. Please be aware that most guidelines do not allow short-term rental income for properties with 5 or more units, right? Usually those are going to be long-term rent only. So do be aware if you have somebody that has a 5+ unit property and they're looking to do short-term rental, you may want to just qualify that then as a long-term rent. But again, where it poses the more bigger issue is if it's a refinance and they're currently already operating it as a short-term rental, you may have issues being able to qualify the borrower. So you'd have to look far and deep to try to get somebody to approve that if they're doing short-term rentals. Now, be aware that when you have a purchase, right, just because the borrower is telling you, hey, yeah, I'm going to operate it as a short term rental, does not necessarily mean that you have to submit the loan using short term rental income. Because remember, if they are purchasing the property, and especially, let's say, for example, if there's a current tenant in place with a lease, then they're not going to kick that tenant out anytime soon. So we would just use the long term rent. Even if the property was vacant, if the property qualifies using long term rent and it is a purchase, then use long term rent. Even, it doesn't matter what the borrower says they're going to do with the property. If it's a purchase and it qualifies with long term rent, then we can qualify the borrower using long term rent. And then after they close, if they decide they're not going to qualify with if they decide they're not going to use operate it as a long-term rental, but they're going to operate it as a short-term rental, that's their prerogative to do so. So you do not necessarily have to qualify the borrower with short-term rental income if it is a purchase, because, and the reason I say that is because in many cases there are loan level price adjustments for using short-term rental income versus long-term rental income. Some cases it's going to be an LTV adjustment. Maybe though, like in some cases, it's a maximum 75% LTV on a DSCR loan. If you're using long-term rent, if you're using short-term rent as opposed to long-term rent, or they may, in other cases, say, hey, it's a 5% reduction from the maximum allowed by the program. So if that borrower's credit score uh, would have only qualified them for 70% maximum, and you're using short-term rent, then it could be then 65%. Now, again, don't generalize across the board on all guidelines. That is only you have to read the specific guidelines because they all change. They're all different from option to option, but do be aware that it is not a requirement to use short-term rental if if they say that's what they plan on doing with the property, if it's a purchase and the property is vacant. If it's leased already, then you're going to use long-term rent. But if it's vacant, then see what the options are with long-term rent, because besides the LTV adjustments, there's also loan level price adjustments, and the loan level price adjustment in some cases may be as high as 2 or 2.5 points add on to the cost of the rate when using short-term rent. Or in some cases, they may say when using AirDNA, right, as opposed to using a 1007 with short-term rental comps. So do be aware, you could have, again, LTV hits or pricing hits if using short-term rental income. So let's get into some of the potential issues that I touched on right now. To formalize what are the issues. So again, first issue here is that the property may be considered a vacant property, right? Like I was just mentioning. And if it's considered a vacant property because it's no lease on the property, then you're going to reduce LTV on refinance transactions, and actually will reduce LTV on purchase transactions as well if it turns out that they are using short-term rental income to qualify. Now, obviously, if the long-term rent doesn't qualify you and you need the short-term rent from income from a short-term rental 1007 or from AirDNA, that would be one reason to do it. But as you're going to note a little bit further down the page, we can always go no ratio or low ratio on a DSCR and still qualify the borrower, in most cases up to 75% LTV with a pretty good rate. So again, bullet point number 2, which I already covered, using short-term rental income may result in an LTV reduction. Using Bullet point number 3, using short-term rental income may result in pricing adjustments. Right, so we covered those, and I gave you more or less the real world example of why, how you could structure your deal with long-term rent if it qualifies, right? So scarcity of short-term rental comps could be another issue if the because if it's a purchase, you have 3 ways to qualify that borrower if they're going to use short-term rent. If it's absolutely necessary to use short-term rentals income because the borrower does not qualify using the long-term rent, and this may happen because the typically properties that are being operated as a successful short-term rental property are going to have a higher cost than a property being operated as a long-term rent. So in that case, the borrower may not qualify with long long-term rent. And then you're reaching out for a short-term rental 1007, and the appraiser says there are no short-term rent comps around here. So then you could use AirDNA, right? AirDNA is a database. It's an Airbnb database, but it's a database of short-term rental properties. So the appraiser would log into AirDNA similar as they would log into the NMLS, into the MLS, the multiple listing service, to look for comparable sales or comparable rentals. Well, in this case, if it's short-term rent, they're gonna log into AirDNA. They're gonna look for similar, because you can't compare the subject property if it's a 4-bedroom 2-bath to an 8-bedroom property. So it has to be similar style of property, similar size, bedroom count, proximity, all the things that you worry about with regular comps when you're looking for, let's say, rental or sales comps. It's going to be the same. Similar, gross living area, similar bedroom and bath count, similar neighborhood, all that kind of stuff needs to line up so that the comparable from AirDNA is acceptable. However, one very important point to note is that when using AirDNA, besides the fact that you may have a loan level price adjustment or an LTV adjustment, the guidelines are usually going to state that a minimum occupancy level has to be met. So AirDNA, when it generates the report, will generate income, right? Projected income for the property, and will also generate a projected occupancy level for the area. In some cases, it has to be at least 50%. In other cases, it has to be at least 60%. So please do review the specific guidelines for the option chosen to make sure that you meet all of the requirements. One other important note when using short-term rental income, and especially when using AirDNA, is that it may require a higher minimum DSCR for a purchase. In some cases, I've seen the DSCR have to be 1.5 when using short-term rental and or when using AirDNA. So do review the guidelines. Again, we cannot generalize here across the board because each guideline is specific to that investor. So do review it and make sure that you're not missing any important points. Now, one other potential issue when using short-term rental income is investor experience. Now, you will note in most cases for a regular DSCR loan, investor experience is something that needs to be taken into consideration, right? In most cases, they're going to require either investor experience or they're going to require the borrower at least have a primary residence that they own, or that the borrower have at least a primary housing expense, right? So those are all things to consider, and there may be more, again, because I'm just touching on certain of the points from different guidelines that I have seen, because again, there is not one guideline that we use across the board for these situations. So, uh, and one in particular I can recall, which is a great option for short term rentals, will not accept a borrower using short term rental income if that borrower does not have any experience with short term rental properties. So, not necessarily just investor experience, but investor experience with managing short-term rental properties, because they are a totally different ball game. And like I mentioned, when using short-term rental income, there may be a requirement of a higher minimum DSCR. For this particular option I was mentioning, it's 1.5 minimum on a purchase when using short-term rental income. So they'll give it to you, but you got to jump through an extra hoops of fire. So I did touch base, and now I'm going to expand on it here. In using DSCR loans in general to qualify the borrower, using long term rent instead of short term rent. So it's going to be pretty easy if you have a projected long term rent income, or if it's currently rented would be even better. But typically the borrower's real estate agent, if this is a purchase, can provide rental comps for the area. And if you get some rental comps, then you can confirm that your DSCR is at least 1.0 or above. Awesome. Um, that's not a problem when it is a purchase. Now, when it is a refi, we do have a couple options where they're just going to ask us for any of the three, either a 1007, be it long term rent or short term rent, or a lease, or short term rental revenue reports for the last 12 months. Or so if any of these factors that you have would work, that's acceptable. And obviously, the best option would be that the long term rent in the area covers, and we get a 1007 with long term rent that covers at least a 1.0 or above, then we're good to go. We don't have to worry about anything. And again, this is one particular option that we have. This is not all options, but this is one of our particular investors that is going to ask either for a 1007, whether it be short term or long term, or a lease, or it's pretty much it, either, or the revenue reports. If it's a seller, the seller is currently operating as a long-term rent, a short-term rent, or if the borrower, if it's a refi and they're currently operating it as a short-term rent and they have at least the last 12 months revenue reports, we can use that. Now, that's a little bit different from some of the other options that if it's a refi, they may ask you for a lease or not. In this particular option, they don't ask us for a lease, so you don't have it leased, it's not a problem. But that's that one particular investor. Most of the other ones are going to ask for a lease if the property is currently owned, if it's a refi. But going back to the long-term rent, if it's 1.0 or above, that's great. We can do 80%. And in some cases, we can even do 85%, right? Depending on credit score of the borrower and all that kind of good stuff. And if it qualifies using long-term rent, that's amazing then. 85% LTV on a purchase, good to go. If the DSCR is less than 1, again, we do have options for 0.75 to 0.99 and options less than 0.75, usually up to 75% LTV. This is as an alternative of having to use short-term rental income on purchases, and even in some cases on refis, right? Where you may have loan level price adjustments, LTV hits. And when the dust settles after you do the math, you may realize that you're going to get better pricing possibly without the short-term rental loan level price adjustment. So again, do be aware of all the different ins and outs of the guidelines for DSCR loans, because like I mentioned, some options let you use just the 1007 or the lease or the short-term rental income. So don't fall into the trap of thinking you use, short-term rent if they're either going to operate it as a short-term rent property or if they um, are purchasing it or if they're currently operating it as a short-term rent. So if it's a purchase, you definitely have more options. If it's a refi, you still have some options. You just have to know how to properly structure the loan. And in some cases, we actually have refis that'll let you use their DNA, short-term rent, if the property was just put into service on a refi, right? So that's another interesting example if you need short-term rental income. Obviously, if the property is vacant and that particular investor doesn't let you submit vacant properties, then they won't consider it vacant if it's a short-term rent, but then you have the other guideline parameters to meet. So I've covered quite a bit of material here. Um, we have very good DSCR options and wanting to see if we have any questions on dealing with short-term rental properties, financing for either a purchase or a refinance. You got to have a question or two out there. I'll give it another minute. All right. Well, short-term rental properties are, again, you guys saw the explosive growth that they have had. There's a lot of them out there. It's a great niche to work. Not very many people understand the ins and outs on financing short-term rental properties and all the flexibility that we have with all the different DSCR programs that we have that already are used to uh, short-term rental properties and have updated their guidelines to reflect working with short-term rental properties. So, no questions today. So, I do thank you for being on today's training, and I look forward to seeing you next Thursday. Thank you, and have a great day. Oh, wait. Okay, no questions. All right. Thank you, everybody. Have a great day. Wait a minute. I do see a question here. I don't know what happened with my visual, but I will answer your questions for the DSCR month. Okay, for the DSCR, the monthly or higher, is that because of the multiple units? Okay, I'm not sure, Nico, if I understand the question for the DSCR, the monthly or higher. No, that's not. You're making an assumption there, Nico. I guess you're talking about Are you talking about the monthly payments are higher? I mean, a DSCR property can be 1 to 4 units or 5+ units. So I'm not really sure if I understand the question. And all right, that seems to be it. Thank you all, and I look forward to seeing you next Thursday on the next training.